Business owners, this is for you. If you own a business in 2026, especially if you're over 50, this is worth the next 5 to 7 minutes of your time. Typically, business owners that I know are smart people. They are running profitable businesses. They have a strong income. They have 7-figure, 8-figure, 9-figure net worths on paper, and a lot of it has to do with their business. But yet what we find is the same 4 mistakes keep showing up, and that's what I want to go over today. So let's list these out. Mistake number 1 is assuming the business itself is the retirement plan, and this is the most common. And if you're a business owner, you know this. And what you say is, I'll just sell the business, and that's the plan. But here's the issue. A business is not a retirement account. It's typically illiquid, and it's obviously very concentrated, okay? And in 2026 and going forward, buyers are going to be more selective. The multiples are tighter, due diligence is deeper, profit quality matters more than ever, okay? So if your personal financial life is completely dependent on a future sale, you are carrying far more risk than you realize. I recently met with a business owner who believed his company was worth five to 6 million, which a lot of folks think their business is worth more than it is, and that's okay. We all think that. But when we looked at the normalized EBITDA and the market comps, okay, so obviously comparables, the business value was closer to 3.5 million, and that gap changes everything. That's $2.5 to $3 million that the business owner thought they were going to get. That is, it's probably just not going to happen. So if your retirement math only works at your, we'll call it optimistic valuation, that's not a plan. Now we are hoping, right? So the business should be one pillar of the wealth, not the only pillar. Okay. Mistake number 2, paying too much in taxes quietly. And this is an interesting one because business owners are incredibly good at minimizing taxes in the moment. I'm smiling because we do everything we can every single year to pay as little as possible right now, and we'll deal with the rest later, right? But many of us are terrible at long-term tax architecture, we'll call it. And here's what I mean. You maximize your deductions now. We're deferring income. We're accelerating our depreciation. We're pushing profits into the retirement plans, okay? And they're typically pre-tax. They're all good strategies, but few people step back and ask, hey, what happens when I sell? Or what happens when depreciation recaptures? What is that, right? What happens when ordinary income converts into capital gains? What if the tax brackets change? What happens when I no longer control the timing of this? So with ongoing tax policy shifts and capital gains uncertainty, this definitely matters more than ever, okay? I've seen owners sell a company and then realize later on that they've stacked up taxes. They've stacked capital gains. They've stacked up state tax, Medicare surtaxes. Now they're in potential phase outs and no structured plan for deploying the proceeds of the sale of their business. And the result, what we see is a massive tax event followed by cash that just has to sit there. And as we all know, then it's not working for us. So tax strategy should not end at lower this year's tax bill. It should extend into optimizing the exit. So remember that. Let's optimize the exit. That is why we say, and I say this all the time, let's minimize taxes now and in the future. It's not an and or a but or an or. It's minimize taxes now and in the future, okay? Legally, of course, all right? So mistake number 3, no succession timeline. This is going to sound very familiar to many of you. Many business owners say, I'll sell in 5 years. And then you say, hey, okay, that's great. What needs to happen in those 5 years for you to be able to sell? And typically, it gets quiet. Rarely do I have a detailed plan laid out. And when I do, that's great to hear. But I'll tell you guys this, in 2026, buyers want clean financials. They want recurring revenue. They want reduced owner dependence. They want strong management, operational systems. And for many businesses, the most valuable is consistent lead flow. Customers coming in to use your services or your products or whatever you're doing, okay? Here's the other thing. If the business cannot function without you, it seems obvious, but many folks, we don't realize this until maybe it's too late. If the business cannot function without you, it is less valuable. And yet, most owners delay succession planning because they're busy running the company. And I understand that, but here's the reality, okay? Value is built intentionally. It does not appear by accident. If you want maximum enterprise value, the prep window is typically 3 to 5 years in advance at a minimum, not 6 months, not, hey, I think I'm going to sell. You want to plan minimally 3 to 5 years out. And typically what I see, the longer we can go, the longer runway, the better, okay? And the earlier you reverse engineer your exit, the more leverage you're going to have, okay? And then it gives us something to work toward. And that stuff is fun and exciting for business owners. All right, let's get into mistake number 4, neglecting personal wealth outside of the business. So this one surprises people. Some of the wealthiest business owners I meet have the most of their net worth trapped inside of their company, as we know, right? So that's minimal diversification. We'll call it underfunded brokerage accounts, if they have one at all. No structured passive income plan. The estate documents are outdated. Typically, business owners have reinvested everything back into growth, and growth is admirable and growth is great, but at some point, wealth must transition from the business equity to your personal security for you and your family, right? Because markets change, industries change, health changes. And if your entire balance sheet depends on one operating entity, your risk is concentrated, okay? The bigger pattern here is when I see these 4 mistakes together, business owners are, I guess the theme, business owners are exceptional operators. But rarely do business owners step into the role of the architect of their own personal wealth. You build systems inside of your company, but do you have a system for your exit modeling, the tax scenario planning, liquidity timing, estate flow, income replacement after the sale? Because once you sell, the identity shifts, the income shifts, the structure shifts. And if you haven't designed that transition in advance, it's disorienting, right? So 2026 is an interesting year, and this will apply going forward too, but we're always approaching potential tax sunsets, okay? Tax laws are going to change, but valuation dynamics are evolving. Capital is still available, but it's selective, and it's getting more selective. And again, this is not a panic moment. It should be a moment for planning. I'll call it a planning moment. But if you own a profitable business and you're within 5 to 10 years of wanting optionality, not even full retirement, just optionality, now is the time to model it, not emotionally, mathematically, okay? So what is your business worth today? What does it need to be worth? What do you personally need net after tax? What is your minimum walkaway number? And what does life look like after the liquidity event? Because selling a business is not only a financial event, it is a major life event, okay? And the owners who navigate it best are the ones who prepare early. So if you're a business owner and you're watching this and you see yourself in one of these 4 areas, that's normal. It doesn't mean that you've failed, as you know. It means you've been focused on building the company. But now it may be time to build that transition plan, because wealth creation and wealth transitions are 2 very different skill sets. Okay, reach out if you have any questions, and make it a great day.
Thank you for listening to the Great Wealth Transfer Podcast. If this podcast resonates with you, reach out to 6 Point Financial Partners at 585-485-6048 or email dpulcini@6pointfp.com.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither 6 Point Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of 6 Point Financial Partners. Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by 6 Point Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services. Member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory LLC, RFG Advisory, or RFG, a registered investment advisor. Private Client Services, 6 Point Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.